0.25%. So uniform 0.25% cuts across the board at this point. I mean, right out of the gates, it's largely 1:1 in terms of advanced decline, although that will start to show up in a more pronounced way as we go through the session. Nifty heat map should give you a quick sense of which way things are, starting out. And it's mostly down. I mean, I think almost 40-odd stocks are lower, about 10 stocks are higher this morning.
Well, a couple of stocks. We start with BSE. The street was anticipating a big gash. That hasn't happened. In fact, BSE is just about 0.8%, 1.2% now lower as we speak. So, the pre-open was a much sharper cut. Right now, as we speak, the cut is accelerating just a little bit, 1.5%. Hindustan Zinc, the block trade has happened, down 6% right now. So let's see where this goes from here as well. And then we are seeing some stocks which continue to do well. Zydus Wellness, yesterday there was that large trade that took place in pre-open. TPG sold out. The buyer was Parag Parikh Fund, and that stock has opened with a gain of almost 3%. Axis Cades is the other one, which from yesterday's up move of 5% continues into today as well. But just as Hindustan Zinc was lower, we have Vedanta, which is higher by about 1.8%. So they get the money. Also, things look favorable for them, as Nigel pointed out earlier. Polycab, the BharatNet business doing well for them. That stock up around 1.5%. On the way down, Biocon, after the QIP opening yesterday, 4,500 crore, opens about 2% lower. And Voltas as well, the management did meet some analysts, made a comment on how demand was impacted by unseasonal rains in peak summer months. And that stock too is down about 2%. Nigel.
Well, that's right. The Hindustan Zinc large trade has got out of the way. So now all eyes are on Vedanta. They have that dividend meet today. And let's see how much is on their radar, because they got close to around 2,500 to 2,800 crores from Hindustan Zinc. Now they'll have additional money. So we'll have to see what do they want to do with that. So that's a stock that we'll be keeping on our radar. Sterlite Technology is cooling off after the big run that we have seen, in the last couple of days. BSE, from the lows of the day, actually, it's seen a solid recovery, actually, BSE, because the markets, as it is, were sensing that there's something coming on those lines. So if you look at it from the day's low, the stock has bounced, I think, close to around 3.5%, 4% or thereabouts. A bit of shorts, I think, covering out on BSE itself. Sky Gold, there's a large trade, I think, that's taken place because volumes are very, very high. The stock is down close to around 5%. So keep an eye out on that one as well. HCC, that's another name. That's a little bit lower on rather large volume. So that's another one. I think from the Nifty, the top gainer actually right now is Indent Bank. Big move, big volumes, stock up 3.5%. And as we did that market check, the Nifty from being down by close to around 70 points is now down only around 20 points.
There's one stock, it's Avenue Supermarts. I'm looking at that one. It's up around 1.5%. Has been doing okay-ish this week. It's up around 2%. An interesting development that took place yesterday. They opened their first store in Uttar Pradesh. And typically, their cluster-based expansion tells you that if they open the first store, over the next 6 months, the store expansion in that space is much more accelerated. And the one thing that the street was eyeing for Avenue Supermarts is store expansion. If they go into the most populous state of the country and, expand out there, that could be a positive for them, which explains why the street has taken the opening of one store positively, because it suggests opening of many more stores.
First in UP.
First in UP.
Oh my God, that's 20 years after, 25 years later, right?
So I remember this, conversation once I happened to have with Radhakishan Damani, in private, and he said that if I don't see 20 stores in a place, I don't open even the first store. This was pre, DMart listing.
Okay. All right. So keep an eye out on this one. Interesting. 1.5% higher. So 4116 is where we have the DMart stock, the Avenue Supermart stock, which is starting up. Well, I think market breadth is down in a pronounced way. 1,500 stocks are lower, 630 stocks are higher, and that's clear skewed lower at this point. Sky Gold is down 4.5%. I think we mentioned that, and of course Hindustan Zinc is down as well. Vari is down 2%. Nothing large. Premier, which is the other solar company, that also comes up. I remember speaking with a Premier recently, and they said, well, there's enough demand locally, at least for the next couple of years. So exports is optionality. So it's not as if, that's what they're depending on in that sense. So keep an eye. Voltas is down 2%. So these are some of the big volume-led losers. Our Power has been a stunner mover this year. I think it was down 5 yesterday, 5 today, but just profit booking, but almost 500,000 shares on it. Already on Reliance Power. Orient Cement is seeing an outsized move. Orient Cement is down 14%. I think yesterday also but yesterday it had a large move on the upside. So a close on Monday was 288, close yesterday was 300 plus, and back at about 262, 260 right now, Orient Cement. So 74,000, 75,000 shares traded. Happiest Minds down 2. Sterlite Tech has had a phenomenal move led by very large volumes over the last few sessions. And Sterlite is seeing some profit booking down about 5%. I mean, some of these are just pure reversals. Look at something like a IKS. IKS was up 7%, it's down 5% today. So I guess little to sort of take signals from these kind of price actions, which are just sort of flip-flop from one day to the next. Mihir Vora is with us. He's Chief Investment Officer at Trust Mutual Fund. Mihir, good morning. Great to have you with us here on the program. Thanks very much. Just your first take on markets. You know, price action is slightly negative, but I guess markets have, over the last few years, with so many conflicts, have learned to kind of ignore or live with these conflicts and look ahead a bit more optimistically. So the mood's not really dulled out. How are you feeling, Mir?
Certainly. Good morning, Prashant. Thanks for having me. You're absolutely right with the market over the last 20-25 years has gone through that huge learning curve, which is the fact that India is such a large market, geographically also so large, that we are quite resilient. And I think the biggest change that has happened, I would say, in the last 10 to 12 years is the fact that we've actually managed our macro very, very well compared to the rest of the world. For example, India is the only country which has reduced its debt to GDP in the last 10 years, even through COVID, etc. So the point is that our currency, our current account, our fiscal, all are looking excellent in terms of the relative scheme of things if you compare it to any developing country as well as the developed world. More importantly, I think structurally now people realize that India may not grow at 10%, but now China is not also growing at 10% anymore. It's probably more close to 4 to 5%. So India will actually be the fastest growing economy in the world. So whether it's the domestic investor sentiment, whether it's the FII sentiment, India stands head and shoulder above a lot of other options out there in the market. And as we keep saying, the local investor has finally come of age. The SIP flows, the pension fund flows, the EPF flows, the insurance flows are now structurally, out there in the market. We are seeing hundreds of thousands, millions of investors getting added to the base every month. And that's what's, I think, keeping the overall sentiment up. We can talk about, the micro and the short-term situation where it's a mixed bag. But in general, I think the structural India story has only become stronger over the last few years.
So in that case, what would be the sectors which you believe would outperform? What specific stocks are you backing, Mihir?
Sure. So, as we have discussed so many times in the past, we continue to believe because India's domestic story is far better than the global story, we will continue to stick to the domestic plays, whether it is, in financials, lenders, as well as the capital market link plays, the savings link plays, whether it's the infrastructure and, CapEx story, both from the government spending point of view. And now we are even seeing green shoots in the private sector capital expenditure, and plus the special areas like railways, defense, etc., that the government is very, very sharply focused on. The mixed bag, I would say, is in consumption, where FMCG, of course, is a lower growth segment. Urban consumption, which was holding up, is kind of maybe not picking up as well as expected. But structurally, I don't think there's a problem there. Over the long term, it should do fine. There is a lot of premium discretionary consumption that is doing quite well even as we speak. So I think premium domestic consumption, savings link plays, capex link plays are something that we would continue to be overweight. Pharmaceuticals, etc., we would be more, healthcare, pharma, we would be more stock specific. And, IT in general, we are underweight because it's more of a global play. Especially the large cap ITs are probably, low growth stories, not as high as they used to be. And of course, the steady growth utilities, etc., with 10-12% growth, we would be underweight because we are looking at higher growth stories.
Okay. Hi, Mir. Since you briefly mentioned capital market plays, which side are you drifting towards with regard to the stock exchanges? BSE and MCX have been absolutely on fire. They've re-rated. Valuations have got very, very expensive out there. But there's still so much of interest. Now, this morning, you have some negative read-through for BSE. But the stock still is seeing buying at lower levels. What's your preference between the listed exchanges? And also, if you want to put in a word on the unlisted NSE stock, which has done a jig of its own.
Sure. So I think I won't comment on specific stocks, but I think the stories that we are playing is basically not only the growth of the pie, the trading pie is going to increase, whether it's from the established exchanges or from the challengers. But more importantly, we are also in some cases playing on newer product introduction, market share gains, etc. So these are stories where we can get the benefit of the tailwind of the industry growing, as well as product improvement, market share gains. So those kind of stories we are playing in our portfolio.
Just a word, guys, with regard to Orient Cement, there was an open offer, so there's a particular number of shares that get blocked, right? So the open offer is out of the way, the kind of support that you've seen because of the open offer. So it seems that the remaining shares could have possibly got released, for being made available for trade. So that could be one of the reasons. And also in the past, when Adani Cement went ahead and they took over Sanghi Industries, the result was not very, very great for Sanghi Industries because everything was in favor of the parent, which is the Adani Cement Group. So because of that, I think that support goes out of the way. Open offer, I think, ended last week. So with that getting out of the way, the stock is down. And as Prashant mentioned yesterday, I think it was higher.
Yeah, it was higher yesterday. The other Adani takeover recently has been ITD, right? ITD Cementation. And that one has gone the other way. I mean, I think since the offer finished, I mean, it was lackluster for a while, from 500 to 800. It was $500 on the 5th of May, and it's at 800 now today. So that's been a very, very sharp move, which has come through on that one. It's up 3.5% today as well, I think. Yeah. Otherwise, I mean, it's it's 1,200 up, 1,000 down. So market breadth is now sort of swung the other way. And we will keep an eye out on things as we go along. I think anything new, anything else? Ask Auto, that's up 9%, is coming up with some 9%, big volumes as well. So that's why I'm mentioning that here. LG Equipment is up about 4%. Mangalam was talking about DMart. DMart's now moved up a little bit more, 2% higher on DMart as it sort of forays into the largest state in the country, Uttar Pradesh. And so on and so forth. So lots of stuff. JSW Infra is up about 2%. Uno Minda is up about 2.5%. So that's the state of affairs this morning. Just a quick word, Mihir, if you will, on I don't know if you have a view, and there aren't that many listed, but there are a few solar stocks. Every time there is news flow out of the US with regards to the thrust is, of course, geothermal, nuclear, even coal. But not renewables in that sense. In the US, with regards to these tax credits, etc., we've seen two developments last night, and the stocks, etc., sold off. Does it have implications for India? Companies have told us when we've spoken recently, companies like Premier, etc., that there's enough demand, at least for the next 2-3 years, till enough supply comes up to meet the demand. So exports is like an optionality. What is your sense?
Sure. So in the renewables space, we are playing across the spectrum, solar as well as the wind part. But we will not typically taken exposure in cases where there is a dependence either on subsidies or on exports, because the US situation has turned adverse ever since the likelihood of President Trump coming to power has been there, and that's because this is not an area of focus for President Trump. So to that extent, over dependence on exports is something that we have avoided. We are positive on the generators in the renewable space, because I think the government is very serious, and any input price reduction, whether it's at the domestic level or from China, only helps the generators. So I think we would stick to the energy generators, and in certain cases, the equipment providers in the wind space.
Okay, all right. President Trump's not too focused, it seems, on renewable in comparison to what the street expected, but he's quite focused on drill, baby, drill. Mayor, if I got it right, I remember in your earlier avatar, you were focusing on some of these pipe companies, and you got the timing very, very correct, on a couple of these pipe makers. With the kind of focus we have seen on oil, crude as well is fairly stable at current reckoning. Do you like anything from that pack? The notable stocks are Welspun Corp. You have Jindal Saur as well that corrected a big deal, but they as well are putting on capex. Smaller players, Man Industries as well has ordered a couple of big order wins. So it seems big orders coming out of the Middle East. President Trump as well, out there, they are laying various pipelines. What do you like from this space?
You're right. We have one of the names that you did mention in the portfolio, and the reason is exactly what you said, that both in the Middle East as well as in the US, there is a case for more drilling, more production, and some of the companies that we own also have facilities in the Middle East as well as in the US. So they will tend to benefit even if there's a US Atmanirbharta, so to say, situation.
Right. Where do you stand on autos? Because as we speak, we're seeing some traction in names like TVS Motors, a lot of the domestic focused names that you like, and if you believe that consumption is likely to pick up, at least in the discretionary end of things, is there a play out there, or you would stay away from autos for now?
So in autos, we have more exposure in the auto Ang space, but that's on a case-to-case basis, not taking a call on the segment growth. But in the OEMs, we have two names. One is a two-wheeler name, and one is, I would say a mix of SUV and tractors, because we do see high-end, as we mentioned, high-end consumption, which includes SUVs, that's doing quite well even now. And rural economy speaking up, the tractor segment is going up. So we have stocks which OEMs, we have exposure to that segment. And in the two-wheelers, we have a name which is anyway quite strong, and which also has a decent exposure to the EV two-wheeler segment.
Okay, well, thanks very much, Mihir, for joining us. You may want to listen into the next conversation because we're speaking with one of the largest public sector banks in the country, Punjab National Bank, next. Remember, last time when we spoke with PNB, post their fourth quarter performance, the management told us that they're confident of beating their FY26 credit growth guidance of 11 to 12%. Now, of course, there is RBI's double bonanza. So RBI is really pushing the pedal as far as growth is concerned. How's the outlook looking for them now, and what changes have they made as far as their borrowing mix and, of course, lending rates, etc. are concerned? Let's get an update. Mr. Ashok Chandra is Managing Director and CEO at PNB, and he's with us now. So good morning. Great to have you with us here on the program. Thanks very much. So just give us the basics, across the liability profile and the asset mix. What are the changes that you've made since the RBI moved?
First I will talk about the liability side. In fact, on 12th of April, which was our foundation day, we have initiated a lot of new initiative backed by the digital side now. And all my CASA products are revamped now today. And we have the special products for all the segments like salary, non-salary, women, youth, defense, pensioners. Even for farmers, we have come out with a new scheme. And I can tell you the success of that scheme that in the last 1.5 months itself, more than 6.5 lakh new accounts which we have opened under this segment. With additional, the saving portfolio in the individual has grown up by 1,000 crore. So we are mopping up the SB individual with the revamped saving schemes which we have brought it in the system. So we are very confident. The liability side, we don't feel any challenge. We have the enough liquidity in the system. Now, as far as the RBI announcements are concerned, I think we must appreciate the very the credible move RBI has made by reducing the repo rate by 50 basis points. And if I see that entire the calendar year, almost 100 basis point reduction has happened. Definitely for 1 or 2 quarters, means Q1 and Q2 of this financial year, definitely the NIM is going to be impacted. But this is all the journey, and we are planning to adjust this the gap which is going to happen in the NII and the NIM by reducing some of our deposit rates. I think in the last week of this month, we are going to have the ALCO meeting, and then we are going to decide about our various rates now.
So just one thing. So Q1, Q2, maybe there will be some impact on NIMs, but
yes,
once you make the changes to deposits as well, will there be any durable, sustained downward pressure on NIMs, 10-15 basis points, or you think,
See, in the shorter period, definitely the Q1 and Q2, there is going to be impact on our NIM by 5 to 7 basis points. But we are expecting that 2 moves which have been made now. One is that 100 basis point cut in the CRR. I think 15,000 crore amount is going to be released in a phased manner from September to November. And definitely that is going to add to my interest income, because whatever is there in the CRR, we are not going to any income out of that. So we will be able to lend this 15,000 crore and we will be able to generate some income. That is the one part. Second part is that we are going to reduce the deposit rate also, keeping the inflation in mind and the repo rate coming down. I think we are going to take the view on our entire deposit rate, including the saving deposit rate. So that also impact we can see from the Q3, Q4 onwards. More so, I think Q4 onwards, definitely there will be a credible improvement in our NIM will happen. All those impact will happen from the Q3, Q4 onwards.
Well, then just a two-part question on that one. One, because you will get increased money from the CRR that will come by to you, the reduction in CRR, would you up your loan growth guidance this year because, you will have more funds to earn interest on? And the second part is the savings rate cut. We recently saw the State Bank of India cut savings rate to 2.5%, which is the lowest that we've ever seen. With you cutting it further and the street, looking at, other alternatives to invest their money, could there be a risk to your deposit growth as well? Because at 2.5%, 3%, people will find it very unattractive to put money in the banks.
First point is the credit growth. I think already we have given the guidance that around 11 to 12% credit growth will happen. And we are hoping that definitely further improvement will happen with our credit growth because a lot of MSME and agri outreach activity bank has initiated. And I'm seeing a lot of traction that is going to happen. I think those results you can see in the Q1 quarter itself. I think that growth, MSME, retail and agri, I'm expecting that there will be a good growth in that particular activity. As far as the corporate book is concerned, I think last time also I had mentioned that we have 1,35,000 crore of sanctioned of the last year plus this financial year. That sanction is already there with us and I'm expecting, and already the movement has started that the disbursement will happen in this quarter and the Q2, Q3 quarters. So we have a good pool of corporate book also. And I'm very confident that with all those initiative bank has taken and the outreach activity bank is doing it, I think we will have a very reasonable and good growth in the credit system now. And with all those moves RBI has made, I think definitely the credit offtake will improve. No doubt about it. Now, as far as the deposit part is concerned, we have a good, the liquidity is there in the system and we don't see any challenge in deposit mobilization. Definitely, I think we are looking into the deposit rate cut, including the saving rate cut. Our ALCO is going to meet on the 30th of this month. And then considering all those factors, the scenarios of the repo cut and the inflation, I think we are going to take the view and then we will announce what are the percentage of cut that is going to happen in the system. But definitely there will be some cut in the deposit, including the saving deposit.
All right. Hi, Mr. Chandra. Good morning and good to see you, Ben. Could you tell us with regard to your loan book, how much of it is linked to EBLR and how much of it is linked to MCLR? If you could give us that breakdown. And incremental loans, what are they going to be given on? MCLR?
We have around 44% linked with RLLR, that is the EBLR. And around 50% is linked with the MCLR, remaining is with the base rate and the fixed rate. So repo rate cut, definitely that has got the direct impact on our 44% loan book. And that's the reason I'm mentioning that around 5 to 7 basis point, keeping everything constant, I think 5 to 7 basis point NIM will shrink. But with the deposit rate cut and the other activities which we are doing it, I think we will be able to mop up our the income. And definitely, I am very confident that overall operating profit and net profit, we will hold on to the level which we have shown in the Q3 quarter.
Okay, all right. So if you could give us what on an average for the year, in the near term, you're seeing 5 to 7 basis points, downtick on NIMs. But on an average for FY26, how do you see the NIMs pan out? Point number one.
I think, the guidance which we have given in the beginning of this financial year, that is the 2.8 to 2.9, I think we are definitely going to hold on this level now.
All right. Your ROA, you want to push it to around above that 1%, guided band.
Yeah.
What are the levels you have in store? Yeah, please go ahead.
We have given the guidance of 1%. And I'm very confident that this guidance we will be able to hold on. Because there are two initiatives which the bank has taken. One is that the recovery, the activity which we have sped up. I think if you see our recovery in the Q4, there was a TW or technical right of recovery itself was around 1,800 crore. And overall recovery was 4,500 crore. And this financial year also, we have given a guidance of 16,000 crore of total recovery and 6,000 crore of technical right of recovery. And we are on track on that in this quarter also. So that is one thing which is going to add to our operating profit and net profit. Second, we have built up a very, very strong treasury book. And I think that is also going to help us in maintaining our operating profit and net profit in this downturn scenario of the NIM also. I think we will be able to hold on to our operating profit and net profit with these two initiatives which the bank has taken. All
right. And final question, Mr. Chandra, before we leave you, the stake that you have in Canada HSBC Life Insurance. They've filed for IPO papers. By when do you expect the IPO to happen? And how much money do you expect to mop up through this offer for sale?
It is likely to happen in Q3. That is the way it is happening now, as of now. And we are very hopeful that at the end of Q3, definitely this process will be on now, and we will be able to see some result out of that. The quantum, I will not be able to quantify it today. I think just wait on some time, and then we will be able to tell how much we are able to realize. But definitely,
you hold about 23% stake in this, right?
Yeah, 13% we are going to dilute, and our holding will be around 10% after the dilution.
Okay.
Right, Mr. Chandra, just a couple of more questions before we wind down, sir. Which segment for you is going to do the best? Is it, and I wanted specific comments on gold portfolio as well, because there also we've seen significant relaxations by the RBI. Could you give us a sense, I mean, first, which of the segments to your mind will grow the fastest, and then a bit of gold. What is the portfolio? How do you see growth there?
Two segment we are pushing very hard, and I'm very confident that will grow at a very faster speed. One is the MSME segment because of our digital initiative. Up to 25 lakh digital onboarding is there. No document is required. Anybody can apply it through the digital channel, through going to our website. And within 5 to 10 minutes, we are going to give the sanction to our existing customer. And to the new to bank customer also, it just requires 24 hours to give the sanction. So this is one activity we are going to push it in a very hard in the entire country. And for that, lot of initiative outreach activity where our entire head office team is visiting in the field and getting the proposals. So that is one activity. Second one, another important activity is the self-help. That portfolio we want to grow up in a very big way. And I'm expecting that in this financial year around 40 to 50% growth should happen in the self-help group and the farm mechanization loans. So these are the two very top priority activity which we have assigned for ourselves, and we are going to drive it in a very big way.
And gold, sir?
Gold, see, geographically also we are not very strong. We all know that most of the gold loans are happening in the south states now, where our presence is not very strong. And gold loan book, if you see traditionally, we are growing at 11 to 12%. And we are going to grow at this speed only. 12 to 13% growth will be there in the gold portfolio.
All right. So, fair enough. Got that. Just one last question, sir. And this is slightly off now the core banking function, but it's important.
Yeah.
We've been reporting on the insurance side, right? I mean, the government was not happy with, the bank assurance channel being pushed in a very big way. But I think there has been a bit of a change of mind there, and what we understand is that the government is told, especially PSU banks, that along with your core banking function, insurance for all by 2047. That's government's goal, and banker channel is pretty important for that. Has that communication come through, sir? I mean, is there a what's the status?
See, the direction was that let us restrict the mis-selling. We should not do the mis-selling of the bank assurance product. That was the concern of the government and the regulator also. And we are very much mindful of those concerns. And in our bank, we are very strict about the mis-selling of the insurance product. Those customers who are willing to buy our insurance product or any other bank assurance channel or bank assurance products, I think definitely bank is there to offer those products. We have a tie-up arrangement with various insurance companies. And anybody who is looking for any bank assurance product, we are there to sell those products. But absolutely, we are very tough on mis-selling. And I don't think any mis-selling is happening in PNB.
Okay, so it's only mis-selling. It's not a step up in overall push. I mean, you're saying it never really stopped in that sense. And the volume of policy sold, that push has been there and it will remain there.
Yeah, definitely. And concern was only mis-selling. And the direction was also how to stop the mis-selling. A lot of initiative which we have taken, like we are taking the mandate from the customer through the OTP, and unless and until customer agrees for that, our no branch is able to sell any insurance product to any customers.
All right, Mr. Chandra, extensive conversation, but thank you very much. Very useful. Appreciate you joining us here on CNBC-TV18. So that's banking, but I guess, guys, from banking to real estate. Let's move on.
Yep, we will. In fact, we were talking about rates coming down, and does that impact the realty space itself or not is the big question.
Well, that's right. Well, the RBI's double rate cut bonanza, that's likely to have a positive sentiment on the sector itself. To understand how's the feedback on ground, we're joined by Pavitra Shankar, the Managing Director at Brigade Group. Hi, Pavitra. Good morning, and thanks a lot for joining in. Let's get straight to that. How's demand on the ground? The RBI governor, has given a bit of a booster shot, which should spur good times for you all. How are you reading it?
It's really great for sentiment. It's really great for our customers. It's very beneficial for them, for anyone who has recently purchased and started the booking journey or even looking at buying a home. It makes quite a big difference. More than 50% of our customers take home loans. So for them, it makes a pretty radical difference, especially as we've seen over the last few years, the average ticket size also increasing across customers. So they're definitely looking at financing their purchases as well. So this is a very welcome news from the RBI.
Okay, got that. So RBI has done its part and you believe demand is good on ground as well. What about the regulators? How are approvals coming around? The last time around we had chatted, you had mentioned that still approvals were taking some time. There were some problems in the Bangalore market. Are things better than the last time? And do you expect to get even better from here on?
We're always hopeful. One has to be in this business that things will keep.
Are there signs, Pavitra, on ground as of now? I mean, hope is not a data point, right? Give us a data point. Are they better than what it was the last time we spoke?
We have received approvals over the last quarter. That's why we were able to launch quite a bit and show good numbers last quarter. This quarter as well, while there are a few small delays on ground, I think now we have visibility and we're going ahead and applying for RERA across a number of projects. So it's not a market improvement, but it is slowly improving. A lot of the e-Khata issues are resolving in Bangalore. So, we do have to just see that there's nothing else unexpected that pops up. But the existing issues in e-Khata and so on are definitely resolving.
All right. Two-part question, Pavitra. Before the RBI policy cut that happened, you had given us a pre-sales guidance of 15%, at least 15% growth in FY26 over FY25. Now that the cut has happened, do you think you can do a little better than that? What's your outlook on this? And the second part is realizations. Now, with the mix shifting towards premium, mid-premium, going away from affordable, the realizations increased by 40%. Is that sustainable?
So a lot of the increase in realizations we've already seen happen in our portfolio. One, like to like as well, price has increased for the same kind of product. We've also changed the product mix, as you mentioned. So we've taken very substantial hikes in our average pricing across the portfolio, as you've seen, 47 to 50%. From here on out, I would not expect it to go in the same trend. One, because we've already launched a number of premium projects. In the coming year, we do have a mix of upper mid-segment and premium projects. We may do a plotted project as well. So overall for the portfolio, I don't see it increasing dramatically the way we have seen over the last couple of years. So I would just say it's a moderate increase. And again, would depend quarter to quarter based on the kind of project launches that we're able to do for that specific quarter.
And what about pre-sales? You've been clocking about, 2,500 crores for the last couple of quarters. Where does that quarterly run rate go to in FY26? And when you say you're not expecting a dramatic increase in realizations, where does that number stand at by the end of this year? Last year was a little over 11,000 rupees per square feet.
Yeah, so I think an annual increase of about 10 to 15% is reasonable to expect, again, based on the kind of projects that we are launching and also adding plotted to the mix as well. So I think that's fairly reasonable. And that's also how we're looking at the market overall. When we're looking at underwriting new projects, we're not expecting pricing on ground that the end customer is willing to pay to really increase in the way that we've seen it in the past. In our portfolio as well, our focus on super premium is still maybe about 15% or so. It's still not a very large percentage of the overall portfolio, but it has moved from mid-segment to upper mid-segment. And now most of our projects launching are in that upper mid-segment category. So from pricing, I would say, 10 to 15% annually is what I would look at. In terms of sales, we don't really do guidance, but I think the rate at which we're clocking is reasonable to expect.
All right, Pavitra, if that realization needs to go up, I'll tell you there are a couple of lucrative markets, maybe the Mumbai market. maybe, foray into Delhi. What's the plan? I think you've hinted in the past that Mumbai could be a market that you'll be looking to expand your presence. Any plans on that front, Mumbai or Delhi?
Not in the recent, not in the very near future. Definitely, we're aware that it's a great market, but we also have a certain focus on South Indian markets. We aim to have really deep presence in these three markets. We still have a ways to go in terms of Hyderabad, expanding our presence there. While in Chennai, we've increased the land bank as well as have a lot of visibility on upcoming launches. So we'd like to do the same, focus on the markets where we've already got a presence and establish ourselves in a deeper manner before we keep adding new markets to the mix.
And finally, what about leasing? Amounts to about 1,100 crore rupees annually for you as a revenue. Where do you see that going?
So the portfolio is about 9.5 million square feet. It's mostly fully leased up. So until we get new inventory into the portfolio overall, which should take another year and a half or so, the rental rates are basically going to increase at the normal revenues. So it's pretty much a fully leased portfolio, and I don't see that moving dramatically higher from here.
You're unlocking value in the hospitality business, so obviously you won't be able to speak about that. But any plans to unlock value in the leasing business as well via, say, REITs or any sort of, business restructuring in a way that you can benefit from the annuity that you get from leases?
We definitely have our eye on that in terms of how we should be structuring our business in terms of the most efficient manner. In the near future, we are not looking at it, but we also want the portfolio to reach a substantial size before we can really think about doing that at a portfolio level.
Would that substantial size entail, according to you?
I think we should be at least 1,500 to 2,000 crores before we can look at that.
And how long before that happens?
Would take at least 5 to 6 years. I mean, we're still in the process of acquiring. We've recently acquired a project in Whitefield. So we would need to ramp up the overall portfolio growth, construction in order to get there. And that's the plan that we are working on.
Okay, all right. Always a pleasure talking to you, Pavitra. Thanks a lot for joining in. You're sounding quite optimistic in terms of demand. Hopefully the approvals get better and, maybe some kind of price hikes as well will be pushed through. And we here in Mumbai will be waiting by to hear about your foray, though for the time being, the South market is your focused area. Appreciate it.
That's all we'll do right now. We'll just wait for the foray because the prices in Mumbai, no way buying new houses or renting them as well.
Well, that's right. We had Prestige, Mr. Razak yesterday, who was telling us about that Pali Hill project. It's a beautiful one, and selling at top dollar.
There's one close to my house as well. The average size of a flat out there costs over 40 crore rupees. So I can just watch from outside and maybe at best eat a bhel outside that thing out there. Maybe. What else can I say? But, be that as it may, a lot of stocks are buzzing around right now. And top of the pops is definitely Indent Bank, up around 5% as we speak. A big mover, and obviously has been a big mover on the way down. So some of those, moves are now unwinding, and the positioning perhaps taking place out there as well. In fact, we'll shortly be joined by Hormaz, who will tell us what's actually causing Indent Bank to move higher. Hormaz actually is with us. Hormaz, 5% higher on this stock.
Months and months of bad news, and finally an upgrade coming in for Indent Bank today. Nomura has upgraded the stock, is upgraded it to a buy recommendation from its earlier rating of neutral. They've raised the target price to 1,050 now from 700 earlier, so that's a 50% bump up in the price target as well, coming from Nomura. And they're saying that these legacy issues that the bank has been grappling with over a period of time have now been addressed, and as a result of which they're expecting their ROA, the return on asset, to improve to around 1% by FY27. And the fact that the management looking to find a new CEO, addressing these issues, and the intent shown is making Nomura optimistic that they are starting FY26 on a clean slate, is what they said. And that in case RBI does approve the promoter's intent to hike stake in the lender, and that could allay some concerns as well, is what Nomura has stated in its note. And the current valuations as well of 0.9 times 1 year forward price to book is attractive as well, is inexpensive, is what Nomura has said in its note. So based on these factors, they've upgraded the stock to a buy, among the top gainers on the index today.
Right, take that point. Thanks a lot. An upgrade coming in on a beaten down stock, and the reaction is for all to see. Let's focus on the tyre industry now. Raw material prices in particular. Rubber prices have seen a sharp fall in the first quarter. How does this rub off on the tyre players? Are price hikes on the cards? Is the export business taking a hit due to global turmoil? Let's discuss all of this and more with Arnab Banerjee, who is the Managing Director and CEO at CEAT, joining in. Arnab, too many moving parts. On the one hand, we have rubber prices which are lower, but on the other, a large part of your raw material also is crude linked. Crude-related, spikes that we've seen, close to $77 on Brent crude right now, and there is a fair amount of global uncertainty as well. In light of that, what's the kind of outlook that you have in the very near term when it comes to margins and global demand?
Good morning for having me here. So you're right, the crude prices have tapered off from quarter 4, but again, it is kind of inching up because of the uncertainties. Rubber prices in domestic have been rock steady. There have been no erosion of rubber price at all. It has been swinging between 197 to 200 rupees per kg. International prices have come down to about $1,650 per ton. So it's a mixed bag and we carry inventory. So the impact of raw material prices in quarter 1 vis-a-vis quarter 4 will be marginal at best, slightly lower definitely. As we go along, if the global uncertainties, geopolitical uncertainties don't play out in an adverse manner, we can expect some tapering down in quarter 2 as well.
All right. Hi, Mr. Banerjee. Good morning and good to see you. And I recall you said that the benefits of lower input costs will start trickling in from quarter 2. But with the world in an uncertain place, do you still believe that we'll see margin improvement from quarter 2 onwards, the gross margins, EBITDA margins? And also, give us some clarity. The government has recently imposed a 5-year anti-dumping duty on imports of insoluble sulfur that's coming in from China as well as Japan. Does that have an impact on your business? And were you importing from both these two countries?
Insoluble sulfur is a small portion of the entire cost structure. So, yes, it will have an adverse impact, but not really significant.
Okay.
But as I mentioned, and I'd like to repeat that there'll be a slow taper off of the raw material situation because of inventories, and the trend keeps getting upset by new developments, as you have seen. Now, freight rates may also move up because of this uncertainty. And the crude has inched up. So if these things normalize, we still hold the view that the raw material should be very, very gradually taper off in quarter 2.
Okay. All right.
And what about demand? Because, domestic business, you were hopeful of double-digit growth. Has that happened so far in the first quarter? Exports, because of the uncertainty geopolitically, are they taking a hit? What's your target for the next couple of quarters and the entire year?
Yeah, I have been mentioning that for the entire year, we still look forward to a double-digit growth, as I've been mentioning at the beginning of this year. Last year, we had a double-digit growth as well. It's a mixed bag, the demand. Let me first handle exports. As I have been saying that given our situation or market share in various markets in exports, moment we get a better access to a market, we keep growing. So for us, the tariff, of course, has to play out, and we need to know what happens to the tariff. But we are not seriously disadvantaged with other exporters. So we expect US growth to come back in quarter 2 or maybe in quarter 3. US doesn't impact significantly at this moment because the contribution to our overall turnover is very, very low. Europe is very big for us, and we expect to grow in Europe. Latin America, Middle East, these are big markets for us. We expect to grow. So it will be a mixed bag, a little bit up and down. So quarter-wise, we cannot say, but for the full year, we're looking at good growth in exports. Domestic market, I think if you see the OEMs, it's again a mixed bag. The growth is slowing down in two-wheelers. There's no growth in passenger, and there's no growth in commercial vehicle segment as well. But as the new models come off the assembly lines of the OEMs, we have visibility of new fitments that CEAT will be getting. So we expect to grow in OEM vis-a-vis last year as far as this year is concerned, starting from quarter 1 itself. Replacement demand, again, passenger is muted. Hardly any growth in passenger vehicle segment, four-wheelers. Two-wheeler growth, which is led by rural and small-town urban, is doing fine. Scooter is doing better than motorcycle. And the GDP growth, as long as it is 6-7%, we are fine on the truck segment as well. So I would say replacement is looking reasonably good.
Okay. Mr. Banerjee, good morning. Prashant here.
Hi.
So basically, you've told us many times, right? So exports and consumer, these are the two areas where which are attractive and better profitability segments as well. Exports, you've already spoken about. Consumer, I think. Overall, I mean, it seems it's a bit of a muddle through over the next 12 months or so. Would you agree? I mean, I was looking at data which just came out. I think it was about a month ago it came out. But after our last conversation, the sales of luxury cars, for example, fell for the first time in 20 years in 2024. We all know what's happening as far as EVs are concerned. So a bit of a muddle through. Is that the right way to look at it?
OEM situation, the data is there up to May, so in public domain. So there's no growth overall, and you're right, the top-end car sales also have tapered off. But we are dependent more on replacement. So the replacement volume is also stuck close to zero. So that is of more concern. However, here, because of 8-9 cornered fight, there is a market share play that will play out over the next 12 months. And we are very much, our strategies and tactics are in place to gain in specific geographies, in specific shares in replacement. And in OEM, our share will increase because of new vehicles coming out with C8 fitment, which has got nothing to do with the overall growth of the market.
Okay, I've got that. So maintaining double-digit growth for the year, and we'll have to sort of course, watch the overall tariff situation, etc. closely. Freight costs perhaps a little higher, especially for imported raw materials. Thanks very much, Mr. Banerjee. Appreciate you joining in, and good speaking with you as always here on CNBC. Let's just look at the market for a quick bit. Up 50 points, 60 points. Mitesh is back with us with what he'd want you to do as far as specific trades go. Mitesh, what do you have?
Morning, Prashant. I think, the IT names are still buzzing, and that's where I think, some kind of movement can happen. So while the broader markets have been quiet, they recovered, but they've been more quiet. I think focus on names like Cyient. I think the breakout happens about 1350 today. I think we got a high of around 1342, 43. So buy about 1350 here. Keep a stop at about 1325. Look for targets against this of 1410. To about 1420. And the other stock which I have is Sell on Steel Authority. That's a stock which is slightly turning negative. Keep a stop just about levels of 130 here. Look for target of around 121.
All right, take that point, Mitesh. Thank you so much for that. Meanwhile, don't lose sight of the market. 24,900 on the Nifty, doing extremely well. The Nifty Bank up around 1/3%. NBFCs are actually spiking right now as we speak. We have Bajaj Finance, which has moved higher. From the broader markets, we have AU Small Finance Bank, which has moved higher, along with Chola Investments and IDFC First Bank as well. So NBFCs and financials doing well. Take a short break. On the other side, Manisha Gupta joins in. Focus on the commodity space. Stay with us.
Welcome back. Let's just take a look at what's happening as far as commodities are concerned now. Markets, of course, are doing just fine. Manisha is standing by with, I suspect oil. Manisha, what else?
Well, yes, that continues to make headlines on every single day until that Iran-Israel conversation, rather not conversation, that war is on, that conflict is on. We will be looking at crude oil prices making those big swings on either side. Well, to begin with, we've seen 4.5% of gains in the overnight markets. It's trading firm even right now in Asia. In the last 1 week, we've seen the crude oil prices gain up by 10%, and it is 20% up now in the last 1 month. It also is gained up by nearly 4% when you talk about 2025 till time. Well, it all has to do with the Israel and Iran conflict, which has entered the day 6, especially with the kind of statements that we are hearing from the US president calling for unconditional surrender of Iran. The Trump also has said that Iran's supreme power is an easy target as of now, and any attempt by Iran to block Strait of Hormuz could send the crude oil prices soaring, or US coming quite heavily on them. This is the main contention right now, because we do understand that at this point in time, there are no oil facilities that have been impacted, and no exports also have been impacted. So the crude oil prices currently are looking at a cap into the international markets. Interestingly, the IEA report also has moved the markets. The organization says that the global oil supply is projected up by 1.8 million barrels to 104.9 million barrels per day for the year 2025. The global oil demand is expected to peak in by 2029 to 105.6. So when we look at the demand, it's slightly higher than what we are looking at in sense of production, but these numbers are for 2029. Interestingly, IEA also says that the global production capacity also is expected to increase by 5 million barrels to 114.7 by 2030. Now look at both these numbers. So we're looking at oil consumption peaking by 2029 at around 105, and the supply is going to be increasing, and that exactly is what the markets are looking like right now. So even as the global consumption will peak in 2029, the Chinese consumption is expected to peak slightly early in 2027 itself. That is because of the EV sales are surging, and they're moving towards natural gas rather than crude oil. So the numbers really tell you that there's not a very strong run-up in the crude oil price as anticipated in the years to come. Not just China, the other major economy like US as well, the EV is expected to account for 20% of their total car sales by 2030. Earlier, remember, that number was much higher at 55% on a year-on-year basis as well. The markets are looking at way more developments that are going to come through. The reason that you haven't seen the crude prices add more premium in these current prices is because, as I said, Israel or Iran, we haven't seen any oil infrastructure impacted right now. And then OPEC and allies also are raising their output. The markets also are looking at higher inventories globally. It is record high production coming in from US as well. So it is the supply side that is keeping the markets capped at this point in time. Going forward, well, it is going to be about the US Fed decision today. While they are going to keep the interest rate steady is what the markets are working with, but it also is going to be about guidance amid tariffs and what is going to be the policy going forward. That is something that the street will keep an eye on. Apart from that, it also is about the US housing data, weekly jobless claims. All of that comes in today, and that will give you further direction.
Manisha, thanks very much for that. So, important contextual information with what's moving right now. Let's talk about the other big story, I think, which, of course, is going to be closely watched. US President meeting with the Pakistani Army Chief later today. Prime Minister Narendra Modi spoke with US President Donald Trump. Here is India's Foreign Secretary Vikram Misri briefing on the talks which were held.
प्रधानमंत्री मोदी ने राष्ट्रपति ट्रंप को स्पष्ट रूप से कहा कि 22 अप्रैल के बाद भारत ने आतंकवाद के खिलाफ कार्रवाई करने का अपना दृढ़ संकल्प पूरी दुनिया को बता दिया था। प्रधानमंत्री मोदी ने कहा कि 6-7 मई की रात को भारत ने पाकिस्तान और पाकिस्तान ऑक्यूपाइड कश्मीर में सिर्फ आतंकी ठिकानों को ही निशाना बनाया था। भारत के एक्शन बहुत ही मेजर्ड, प्रिसाइस और नॉन एस्केलेटरी थे। साथ ही भारत ने यह भी स्पष्ट कर दिया था कि पाकिस्तान की गोली का जवाब भारत गोले से देगा। प्रधानमंत्री मोदी ने राष्ट्रपति ट्रंप को स्पष्ट रूप से कहा कि इस पूरे घटनाक्रम के दौरान कभी भी किसी भी स्तर पर भारत अमेरिका ट्रेड डील या अमेरिका द्वारा भारत और पाकिस्तान के बीच मध्यस्थता जैसे विषयों पर बात नहीं हुई थी। सैन्य कार्रवाई रोकने की बात सीधे भारत और पाकिस्तान के बीच दोनों सेनाओं की एग्जिस्टिंग चैनल्स के माध्यम से हुई थी और पाकिस्तान के ही आग्रह पर हुई थी। प्रधानमंत्री मोदी ने जोर देकर कहा कि भारत ने न तो कभी मध्यस्थता स्वीकार की थी, न करता है और न ही कभी करेगा।
Welcome back. Bank Nifty is one of the better performing indexes today. We have to remember that the latest RBI policy has clearly turned the tide in favor of banks by cutting the cash reserve ratio by 100 basis points, entirely unexpected. This allows banks to lend another 2.5 trillion rupees, which they had to keep as idle cash under CRR. The move is so powerful, I would think, that even the beleaguered Indent Bank has been upgraded today by Nomura, probably partly at least because of this move. It clearly helps everyone's margins and ROA. To get an idea of how much banks benefit from these and other factors, I have with me a banking expert, Shantanu Chakrabarti, the India BFSI analyst at BNP Paribas, that is Banking and Financial Services expert. I'm sorry for the abbreviation. Morning, Shantanu. Thank you very much indeed for joining us. Well, first for banks as a whole, how do you see the margins moving? Clearly, this quarter it's going to be jacked because of the double rate cut, and Q2 may even be worse, isn't it?
Yes. So, whether the margins bottom in Q1 or Q2 would depend a little bit on, what is the mix of repo-linked loans which are adjustable within the first month versus over a 2 to 3 month period. But in any case, some of the adjustment for most people will fall in this quarter, while some of the adjustment will fall in the next quarter. So, between Q1 and Q2, there may be slight erosion, and this may differ from bank to bank. But by Q2, you will have the bottom on margins, from which point onwards, margins will actually become a tailwind.
Okay. So, for a typical bank like, say, HDFC or SBI, will the margins in the fourth quarter of FY26 be better than the fourth quarter of FY25 or as good at least?
Yeah, we actually expect that to be the case, that for most large banks, by the exit margins of the current financial year are going to be better than the one gone by. So the arithmetic on this is very simple. We were going to get about 15 to 20 basis points worst case margin impact directly between this quarter and the next. Now, how that spreads between the two quarters, it depends on the individual banks, but that's the broad impact. But then from that point onwards, you start to get about 4 or 5 basis points of annual expansion from that point, and quarterly expansion from that point. So by the time you get around to exiting FY26, you are going to see meaningful, impact on the bottom margins, whether they are formed in Q1 or Q2 for that individual bank. Now, to give you a sense of how much this could be, we have run a small exercise on how the existing, pre the current rate cut 50 basis point kind of impact that was there on FD rates, that was repricing the currently existing back books of banks on FDs at about 15 basis points on average, which is a fairly, robust number, especially since for most large banks, FDs are now north of 50% of their total demand and time liabilities. And of course, CD rates are also very low at around 6.2%. And there the entire repricing will be done in 1 to 2 months. So all of these become tailwinds, and we are expecting a pickup in CASA as well.
Okay. Now, what is the advantage on CRR cut? Would it be maximum for SBI and HDFC Bank simply because largest in deposits?
Yes, that's one part. Now, the second part of this is how much of this, what does it mean for the overall balance sheet? Does it mean a little more deployment on the investment side? Does it mean a little more conservatism as to what rates you pay on your deposits? Or would it mean greater credit? I think it will be a combination of all three, because that's simply how liquidity works. We are yet to see a meaningful acceleration in credit growth. You must have seen the latest numbers, which are running at about 9.9%. So our expectation is that within the next 2 to 3 months, this excess liquidity, especially with the promise of that entire number coming between September and November, loan growth should start to pick up. And that's where a lot of the positive surprises should come from.
No, I'm glad you raised the issue of loan growth, because immediately after the CRR cut, I personally spoke to bankers. There is a problem of borrowers. There is a lack of borrowers. Corporate sector is obviously borrowing from the bond market, if at all it is borrowing. They have excellent internal accruals. Retail, the Reserve Bank has put its controls on unsecured credit with good reason. I'm not sure that they should even lower them. So where do you lend? Everybody says MSME. Is it really possible that MSMEs can gorge so much credit?
MSMEs in any case are about 15 to 17%. But the growth rate there is very high, and there doesn't seem to be any major headwinds. Now, we have a full year system credit growth number of about 13%, Lata. And that actually builds in about 7.5% for corporate loans. So in corporate loans, frankly, at some point there will be capex, etc. But it is very hard as an analyst to sit down and say that it's going to happen right now, especially given where the global macro stands and the specific nature of the global uncertainties. Yes, so, yes. We wouldn't be banking on corporate loan growth supporting it majorly. The only point I'll raise is around retail. Retail, there's now two positives. One, given how sharply growth rates were pulled back in unsecured loans in the previous financial year, especially in the last 3 quarters of the previous financial year. From this next quarter onwards, growth rates on a year-on-year basis, even without too large of incremental disbursements, start to look a little better. The base
is
starts
low,
to look
yes.
better. Right.
Yeah.
But
Shantanu, sorry, go ahead.
So based on that, I think 15% system retail growth is quite possible this financial year, which I mean both on the mortgage side and on the other side.
I would assume gold will give a lot of fillip on the retail side.
But the weightage there is low. I mean,
it's very low, very low for banks. It's more an NBFC thing. What about, this is a kind of a casual conversation with only one person who's more an economist and a statistician. He expects infra loans to pick up because the same point that you make. Why will corporates invest in an era where you don't know which tariff will hit in which country and on which product, which is why corporates won't. But infra is not similarly related. I mean, if it is roads and because of road cement, the government is pretty determined on infra, rail and road, and perhaps irrigation. Do you think, have you done any study of infra loans and can that be a loan puller?
See, I mean, infra loans, I see 2 major headwinds. One is fairly recent memory of it, right? And where, you talk to any bankers, there seems to be this idea that, let the specialists and, which specific NBFCs I'm talking about, do that and, we maybe take a back seat. So it's exactly opposite of what 2010-11 looked like. The second part is, I mean, also please think about the provisioning norms which have been proposed. If they come through, it would be very hard. I mean, effectively, you'd be earmarking upfront provisions, half of an NPA to make an infra loan, which makes them very untenable at a accounting level. I don't know how where the dust settles on those norms, but as the norms being proposed, if they stay, then, I mean, infra to a bailout, I mean, these are good. These would be good to have at some point, and I'm sure, given the nature of the problem, some solution will arise. But none of that is baked into our 13% growth number.
Okay. No, I take your point. Actually, even with infra, there are already people complaining that Nal Se Jal project money is not coming. Because it's a central project, they have not given the states and the states are defaulting. Not defaulting, postponing. No, the entire problem of infra is not resolved. But, well, at least a lot of investment activity will happen there, albeit not from the private sector. Okay, Shantanu, now tell me your hierarchy of buys. Okay, talk about banks.
Yes, so HDFC is, of course, still our topic. We don't think that the valuations fully accommodate the margin story. And as far as, rate cuts stimulating CASA is concerned, HDFC Bank and Axis Bank probably remain the most sensitive to a liability side easing story over the next 4-5 months. Valuations are still favorable. Within NBFCs, we continue to prefer Bajaj Finance because, some of the other NBFC valuations do look a little, if not stretched, at least not as attractive as some of the top bank valuations look like to us. So, they appear to be very counterintuitive beneficiaries of easing, but there's a strong case for HDFC Bank at current price. You know my target price and how aggressive it is.
Your target prices are running, as you speak, 2770 for HDFC Bank and 11,120 for Bajaj Finance. Now, I take your point. Houses in Altamount Road never come down. So, one has, if you aspire so high, you have to pay the price. Just a final question. Do you see NBFCs having an edge over, a trading buy over banks in the first half, since banks are going to suffer margin loss? And a second and related question somewhat, should we stop looking at margins for banks and look at ROAs? Simply because margins have this peculiarity of EBLR.
Right. ROA is, of course, the ultimate thing that you earn from the business. And as long as your leverage is not, something which in itself becomes a question mark, which on one side could describe PSU banks, on another side one could make the case, and in fact Kotak Bank itself said on its call that it's got too little leverage or too much equity. They acknowledge that, right? But other than that, ROA is a very fine thing to focus on because it is the ultimate profitability of the business. But there is no major shocks coming either on credit costs or operating costs. So at least for the rest of the year, margins and ROA would be pretty synchronous for most names, unless specific credit events happen in one to balance sheets. And as far as the NBFC trade is concerned, as far as the NBFC trade is concerned, and we have discussed this before, Lata. Some of the top tier NBFCs have margins between 800 to 1,000 basis points, and say about 40-45% of borrowing is from banks. 20 basis points on 1,000 basis points, especially when the NBFC would also be repricing their own loans downwards just to improve affordability, gain market share, etc. It's perhaps not the best prism. I mean, he noted that their margins are a little better protected in that near-term 1-2 quarters than banks, but that is perhaps not the best filter to look at the fortunes of an NBFC. An asset cycle will probably be a better filter, whether that's in growth terms or quality terms.
Yeah, fair point. Point taken. We could go on about NBFC asset qualities as well on a later date. Thank you very much, Shantanu, for joining us. Meanwhile, markets have just given up a wee bit, but perhaps it's just a trading profit-taking. Chartbusters will take the action forward.